Good morning, everyone. It's my pleasure to introduce our next speaker, Mr. Robert Cook, who's the CEO of FINRA. He's a very accomplished attorney. Before being appointed the CEO of FINRA last year, he's also worked in SEC. He was a practicing attorney in securities law. He brings a deep knowledge of how the capital markets work. And I would also like to introduce Nicole Bullock from Financial Times, and she would be holding forth on this conversation. So welcome, both of you. Wonderful to have you. Thank you.
Thank you.
So given that we're coming up on the 30th anniversary of the 1987 stock market crash, we thought it might be a good idea to start there, because I would imagine over the next week or so, you're probably going to hear a lot about this topic. Lots of old photos of the exchange floor and old newspaper front pages, things like that. So it seemed like a good way to kick off the conversation. So I thought it might be a good idea just to start with a brief explanation of what happened that day. And obviously, this has been the topic of debate for basically since it happened. But there's a few points of consensus. Maybe we can just start there and then take it from there.
Sure. Well, let me start by thanking Georgetown for inviting me here today, and thanks to all of you for being here. Look forward to your questions later on in our segment. So, I'm not going to be able to resolve all the open issues about what happened in 1987. I would like to clarify that I was not there. I was a senior in college, and I was not focused on this at all. But it stands out as kind of a seminal event, in part because it was such a significant crash. The markets went down about 22%. Before that time, a really bad day was 5 or 6%, and a really, really bad day was about 10%. And if you look at trading that even happened after that, the next day was down about 36% total from some of the highs. There had been a long bull run market, and then in August, September, October, things started going down. But that was clearly a seminal event in the sense that, wow, markets can really crash, and we need to think about the implications of that. And in terms of what caused it, I think some of the theories that and reports have suggested things like program trading, portfolio hedging, so a lot of automatic selling activity flooding into the market. And there were some issues with the plumbing of the market at the time, and a lot of steps taken since then to address those issues.
So if we look at that specific part of it, what aspects of the actual market structure do you think contributed to the crash that day?
Well, I think it was a very different market structure than what we have today. And so a lot more trading was concentrated in single markets. So back then, if you were listed on an exchange, most of the trading in your stock would happen on that exchange. I'm not saying there was anything wrong with the particular exchanges, but there was one of the concerns that you might have had at the time was if all the trading is concentrated, are there backup mechanisms? Another thing that people talk about more afterwards, or what are the obligations of market makers? And that's the time when people talked about not answering the phones or pulling away from trades. If you're a market maker, what were your obligations? And frankly, those questions are still, in some ways, still with us today.
Right. So what would you say are some of the changes that we've seen in the market structure? You mentioned a few things, but if we could really dig into that, because I think probably the burning question that will come up over the next week or so is, can this happen again? So if we try to think about what are the changes that have been made since then, 30 years is a long time, particularly given the technological advancement that we've seen, the regulatory change that we've seen over that time period. What are some elements that we can pull out that would potentially prevent another kind of runaway decline like that?
Well, just to talk a little bit about how the markets have changed, and many people in this audience know as much or more in many cases than I do about this, but the markets in some ways become much more fragmented. We have new regulatory regimes that have both responded to and caused some of the market developments since then, whether it's Reg NMS or change the order, how orders are handled. But what we've seen is a lot more trading activity happening on different venues. So at the time, I think there were 9 exchanges. Now there are 19 in the equity market. So more trading venues that were registered as exchanges, and then a lot more off-exchange trading activity happening through ATSs or other types of non-exchange venues where orders can happen. So a lot more fragmentation in terms of where orders can get executed. And that's led to more complexity. And one of the challenges for regulators is how to deal with that complexity. It's also led to, in some ways, many good things. There's more competition to get the orders, which in sometimes has led to more innovation, more product development, more new technology. And so the competition among venues to get orders has also led to the flip side is the fragmentation. The execution costs have gone down a lot. I think I saw some statistics that back then, the average spread for some of the more liquid securities was about 50 cents. And some of the same securities, now it's more like on average 2 cents. So there's a lot of, one could argue a lot of good has come from this for investors. But you ask, could it happen again? And there have been a number of steps taken to try to address this. But we had the flash crash in May 6th of 2010. So there is an ongoing concern that these sorts of events could happen again. But there have been many steps that the SEC has taken. For example, there are now market-wide circuit breakers, and those have been updated after the May 6th flash crash to establish tighter bands where trading would halt and provide an opportunity for liquidity to enter into the market and be regenerated. The SEC has also, post the flash crash, adopted other types of measures, including single stock volatility mechanisms or restrictions. So first they had single stock circuit breakers. Those were followed by a limit up, limit down system where if volatility in a particular stock exceeded a band, there would be a halt on pricing above or below the band, and then, if necessary, a pause in the trading to allow stock liquidity to be replenished. And so those sorts of mechanisms and others have been adopted post the 87, post the flash crash, but no one's in the business of giving guarantees about these things. So it is something that I think regulators have to continually focus on.
And then there was a further refinement of those limit up, limit down, as they're called, measures that were put in place after the flash crash when there was a big, some market turbulence on August 24th of 2015. So that people talked about as the first sort of test case of the measures that were put in after the flash crash. At that time, some people talked about feeling that the industry came together and worked on these ways to make those measures better. But one thing that I hear a lot is some concern that there isn't more coordination among the various markets. So now we have a lot of trading strategies that use cash, futures, and ETFs, and these are sometimes regulated in different ways. And should there be more coordination in that area? What do you think about that?
Well, I think we do have a structure where we have multiple exchanges who are self-regulatory organizations, so they are regulators of their markets, and they work hard to make sure that their markets are operating fairly and providing an opportunity for investors and issuers to feel like everyone's playing on a level trading field. There's a trade-off with this approach of having the same stock being able to trade on different venues, which is that there will be different rules applicable to these different venues, and that's both a good thing and a challenge in some ways. But my sense is that that everyone wants to get to the right place here, and so there is an awful amount of coordination and collaboration that happens between the exchanges. FINRA plays a role in that. Now 38% of trading and listed stocks happens off of exchanges. So it's happening in venues where FINRA is a primary regulator. So we work closely with the exchanges in a lot of different ways, and I think there's really coordination is one of those things that's always going to be something we can't ever say we're done with. There's always needs to be more work and more effort.
So you mentioned portfolio insurance as one of the elements involved in the '87 crash, and I think there's general agreement that at least made things worse, if anything else. Is there a modern equivalent of portfolio insurance that we should be concerned about these days?
Right, this is one of those dangerous questions. If I mention something, then I'll be putting a black mark on it, and anyone who supports that will say, what were you saying? But I wouldn't identify any one particular type of trading strategy as of concern. You know, we at FINRA, through our close collaboration with the exchanges, perform a coordinated regulatory function now, where we pull in data from the exchanges and from the broker-dealers. Right now, about over 99% of the listed, the trading in listed equity securities, and something like 65% options. And again, together with the exchanges, run surveillance patterns over that and look for anomalies, look for things that you've probably heard about in the popular press, like spoofing or algo gaming or layering, or all kinds of fun words like that. To look for that type of behavior, that's a different type of concern. That's more about individual trading strategies that are designed to change prices in ways that are favorable to the trader.
Right.
In terms of like a market, a breakdown in the engineering of the system, right. Obviously we're all looking out for that all the time, and this is one area we have a collective interest, whether it's the SEC, the SROs, or the dealer community, to try to identify those sorts of risks.
So people seem to be perennially worried about the growth of ETFs. Is that an area where you see maybe some cause for concern, or the potential for a systemic risk of some kind?
Well, they have become a very popular product, and they serve a great function for people who want to have the type of exposure you might get in a mutual fund, but also the liquidity that having it being traded on exchange provides. So, and we have seen significant growth. I would say that whenever we see a product attract as much investment interest as they have, of course we're collectively all focused on it. And I know that people raise concerns about creation, redemption process. I think there's been a lot of focus on this lately by the exchanges and efforts to try to help deal with special mechanic issues that those types of products raise. So I think it's one of those things that, among others, that we have to watch out for, but I wouldn't say this is the next, that we have any reason to think that this is going to be the next source of a crash or something like that. I don't know, but I don't think that it's just something we watch out for because of, again, anything that gets that much retail interest in particular we're focused on.
You mentioned this idea back in '87 of people, not picking up the phone. So the makeup of what used to be the specialists, now the designated market makers on the trading floor, has changed dramatically. It's no longer dominated by banks with balance sheets. It's high-frequency traders and independent market makers. Do you see a risk in that you don't have groups performing that function who can rely on a big balance sheet if they need to?
Well,
or maybe that's a good thing. I don't know.
It's a good question. I mean, I think, yes, there's been a growth of high-frequency trading and a lot of liquidity provided by high-frequency traders, which is a good thing. It's something that we also saw in the flash crash. I was at the SEC at the time of the flash crash, and we were trying to immediate aftermath to figure out what happened, and doing a lot of data analysis, and the data wasn't as good then as it is today, but doing also interviews with firms and trying to understand what was happening. And not surprisingly, a lot of different types of firms, when they saw anomalies in the data streams that they were getting, would pull back. If you you teach your computer that if you don't know what you're analyzing, then stop trading, right? And so there was, in that short period of time when things were happening so quickly, it was natural for a lot of different trading activity to be pulled back, and that likely contributed to some of the challenges on that day. And I think that's what led to the idea of having both tighter market-wide circuit breakers to allow liquidity to replenish, and also the limit up, limit down system for individual stocks. It is an ongoing question today. Is there enough provision of market-making services? And that's a debate that we're not going to resolve now. I do think that in some ways it's been a diffusion of market-making services that's been provided. In other words, it's not just the market makers on each of the exchanges providing it, it's others. And this idea that some people are trading electronically and others maybe not. Everyone's trading electronically now. You really can't be trading this market on an active basis if you're not trading electronically. And so who's a high-frequency trader is an interesting question. I remember when I was at the SEC, it actually was a more contentious topic than it is right now. High-frequency trading got more questions about it. And then we would talk to people who'd come in who'd say, you really ought to do something about high-frequency trading. And we'd say, okay, what if we did this? And they said, well, no, don't do that. That's what I do. Or maybe you should do this. Don't do. And these would be institutional investors. So you have to be a lot of the trading strategies that people pursue are ultimately enabled by technology, even if the decision maker is a human as to what to buy and sell. And you have to be very careful about constraining what is happening there because of the unintended consequences for liquidity.
So, given the recent events with Equifax, what about a threat from the outside? There's been a lot of, and I'm sure there'll be a lot of debate over the next week or so as to what could be the potential strategy or component of the market plumbing that could be the weak spot. But is the weak spot potentially the ability to hack the system?
So obviously this is a concern that it's one of those things you can never feel confident that you've done. Every institution needs to be worried about cybersecurity. So it is certainly one of the areas that we focus on in our examination and oversight of broker-dealers is cybersecurity. Now, we try to be thoughtful about this, that we have many different types of broker-dealers and one size doesn't fit all. And we're typically more in the mode of trying to give people suggestions or advice about, hey, observations, so to speak. We see this, you might want to consider that, because we don't have a specific cyber rule, but we all know it's important. And this is an area of shared interest, I think, between FINRA, which is an SRO, it's a membership organization. Our members care deeply about getting this right, and we want to help enable them to do that. And the exchanges also are very focused on cybersecurity. I think it is maybe an area where there's some opportunity for more of a federal set of standards to be developed to help give people a sense for what the expectations are, or to give regulators like us a set of standards to say, hey, this is. And there are some standards out there, and a lot of firms follow those, whether it's NIST or ISO. But I do think federal level leadership on this might be helpful. And I say that, I'm a regulator. Why not FINRA leadership? We're happy to participate in this, but I think what would not be helpful is to have different sets of rules be established by different regulators, and then just have an overlapping, framework of potentially duplicative and maybe even inconsistent requirements for the regulated firms. So I think that's an opportunity area for more focus, and maybe that'll be one of the things that comes out of some of the recent news.
Is there any effort underway at this point for something more federally organized?
I think there's been conversations about it, and there's been, I think I'm not the only one who has suggested that maybe this is something where regulators ought to come together and have a consistent approach. So I'm hopeful that there be focus on this going forward. I think it's an area to be careful because, again, one of the reasons that you have to tread carefully is not every firm's alike, and what works in one situation may not work in another, and some of this may be policies and procedures based, or you're giving guidance like that, like make sure you have a system for addressing this risk. And so hopefully that's kind of the direction that we would be able to find some common ground on.
Another one of the themes right now seems to be an effort and desire on the part of the administration to really take a look at the system. And last week we had this big report from Treasury, quite extensive. What really jumped out at you from that?
Well, I did the Washington read of the report. Sure, someone here, Jim knows the Washington read, which is that you get something and the way you read it is to quickly look at the index. Now, I didn't even notice there's an index, but nowadays you can just type in your name and do a search, right? And that's a Washington read, doesn't mention me. And so I've done the Washington read to look at what it says about FINRA, and not a lot, but I did think that there were a number of recommendations about market structure initiatives that are, I thought were interesting, some of which the SEC has already undertaken, and others that some ideas have been discussed here earlier today. I don't know whether it was discussed earlier today, but another area that I thought was interesting that they chose to focus on was a review of SROs. What is the role of a self-regulatory organization in our market oversight now, right? Traditionally, the SEC is on the security side is the primary regulator responsible for what happens in the markets. And both by statute and policy, a lot of that oversight has been delegated to SROs, of which we're one, and there's I think 33 SROs or something like that in the securities markets, whether it's a clearing agency or the exchanges or MSRB or us. And they're all different in the functions they play, and they all present different issues, but I was interested that they seemed to support a review of SROs in our market structure today, in our regulatory structure today, not just on the SEC side, but also on the future side, the CFTC side. And I think that's fine. I think I've been very open as a relatively new leader at FINRA to step back and ask, what is our role and what should we be focused on, and look inward at how we do our business. We're about 10 years old from the merger of the NASD and the old regulatory functions of the New York Stock Exchange. So for us, it's a ripe time to be looking at some of this. They did actually call out FINRA's effort to conduct this review and suggested other SROs do it as well. So we took that as an affirmation that we should keep doing more of this, at least in their view. But it's something we've been doing already, but I'll be interested to see whether that particular recommendation of looking at SROs gets any traction with the SEC.
Is there something in particular that you would like to see altered or changed in some way?
Well, I think there are plenty of people who have commented extensively on what they'd like to see SROs do differently. And I think that's where some of that commentary is coming from. I think that, there's not a particular thing I would call out, but I think it's healthy for SROs for us to revisit this from time to time. I'll just talk about FINRA. We are an entity that has conflict embedded in it, right? We're a membership organization, and the whole purpose of our structure is that our members get to have a voice in our policy making. And that arguably creates a conflict because we're also regulating them. And I don't think we can pretend that doesn't exist. We have to acknowledge it and balance it, constantly calibrate. And in our case, the way that balance is struck is by giving members and their representatives the opportunity to participate in our rulemaking. They are represented on our board. They are represented on hearing panels when we bring an enforcement decision. But it's counterbalanced by two things. One is majority public governors on our board, and number two, close SEC oversight of our activities, and to hold us accountable and make sure that we are holding the industry accountable. When you're dealing with that type of structure, are you getting it right, every day? I think that's something you have to always ask yourself. If you don't get enough industry input into your rulemaking, then what's the point? if you don't take the industry's view into account or don't engage with them productively to bring their expertise around this very complicated set of issues into the way you regulate, then we might as well just be folded into the SEC. On the other hand, if we're not holding the industry accountable and making sure that we're regulating them closely, then we're not doing our job either. So that's one of the areas that we've been thinking about, but it's one of those areas I think we have to recognize that SROs present these sorts of conflicts and therefore deserve the opportunity to, the public and policymakers should be revisiting from time to time whether we've struck the right balance.
What would be a way to bring the industry more into the rulemaking process? I think that's been one area where we've seen a bit of, say, friction, but there's some people in the broker community feel that they're not involved enough in that process, and some of the SROs have pushed back that there's lengthy comment periods and it's all very public. Is there some way without having it be so procedural and long and involved to just make that happen within the industry itself?
Well, it's a really good question. That is one of the areas that we've gotten feedback on, and one of the ways we've tried to get our arms around the problem is by issuing a notice that asked people to give us comments on our rulemaking process, among other aspects of our operations, and we've gotten some good feedback about that. So right now we do have industry input in the sense that our rules go out for comment by the industry and the public, and then they eventually get filed with the SEC, where for a second time they go out for comment by the industry and the public. And then we have industry committees and investor-oriented committees that look at all of our rules before they go to our board. So there's input at that level. And so in light of that, one of the challenges has been, well, so where's the rubber not hitting the road? Where do people feel like they're not getting the benefit? So I think we've identified a number of areas that are kind of procedural. Little stuff makes a difference. And so helping people having more of a dialogue with the industry committees that we have. We're taking a look at whether we have the right committees, whether we are structuring our interaction with them in the most productive way. Sometimes they feel like we're just lecturing to them. Other times we are better at getting their input, so we need to do a better job of that. Sometimes there's a question about whether they understand how their input was used by us, so more reporting back to them about, hey, we heard you on this, and we made this change, but on this one we didn't because we thought X, or this other committee said Y, or whatever it is. So we're looking at ways that we can empower that process more effectively. Again, we have non-industry people in the mix here too, so we're trying to strike the right balance between industry and public interest.
So the report seemed pretty massive. Maybe we want to break soon for questions. So why don't we do that, and then if there's time after, I'll ask the last question.
We want audience questions. We have time for one or two questions. Okay, right. Back to you, Nicole, then.
Well, I was just going to say that the Treasury report seemed pretty massive to me as well, quite an undertaking. Do you have a sense, or is there any indication of where the priorities are? Because there were certainly tons of recommendations, tons of interesting areas that we want to look at, and it struck me as really hitting on a lot of the things that I've heard over the past couple of years that people are interested in. Mm-hmm. So is there any indication of what's at the top of the agenda?
I don't know that I haven't had enough time absorbing the report to have a view on that. I mean, I think the report probably speaks for itself in terms of what they want the frontline regulators to focus on. And so I think the next question will be those regulators to whom most of the recommendations are directed, what do they think? And it's going to take them some time to absorb those recommendations and the like.
At this point, can we thank Nicole Bullock and Robert Cook?
Thank you.